A very pleasant morning to everyone. This is Ashutosh Mehrotra, teacher of City International School, Lucknow, welcoming you all to this live session on accountancy. Before starting my session, I would like to give my gratitude to our respected Director Ma'am, Dr. Sunita Gandhi, and to our respected Principal Ma'am, Ms. Archana Gaur. Today's topic of discussion is Partnership Fundamentals of Class 12 from the discipline of accountancy. Today we're going to discuss about this chapter. A few topics from this chapter will be discussed, and a few topics from this chapter will be discussed. But before starting the topic, it is very important to understand that why partnership form of business is very important, or rather why partnership form of business came into existence. In sole trader form of business. Good morning, sir. Good morning, Shilpi ma'am. In sole trading form of business, one person invests the capital. He takes all the risks involved in the business, and he just manages all the affairs of the business. So it turns out to be a bit difficult for a single person to carry out all the activities, and generally the capacity of a single person are limited. So the risk taking to overcome such limitations of a sole trader form of business, partnership form of business came into existence, which has been governed by the Indian Partnership Act 1932. Now, something of very much interest, that Partnership Act, or rather partnership form of business, has two aspects. Has two aspects. Basically, when we go to the accounting aspect of partnership, partnership is partnership firm is basically a separate legal entity distinct from its members when we are talking about partnership form of business in accounting aspect. But as we move on to the legal aspect of partnership firm, partnership form of business, rather partnership firm is not distinct from its members. That is, partnership firm does not have a separate legal entity distinct from its members. Thank you, sir. Good morning, Archit sir. So now, the basic concept lies here that when we come down to the legal aspect of partnership, legal aspect tells us that the partnership firm is not a separate legal entity from its partners. So what happens whenever the partnership firm turns bankrupt, or whenever the partners are bankrupt, the legal estate or the private estate of all the partners will be joined, and the outside liabilities, or rather the third party liabilities, will be paid by joining the private estates of the partners. Now, this is the legal aspect. This is the legal aspect of partnership form of business, which has been governed under the Indian Partnership Act, that says, or that makes the partnership form of business an unlimited type of business firm, or an unlimited type of business concern. Now, moving further ahead, uh, one thing, to make partnership form of business, the concept of partnership more evident, we need to divide the partnership form of business into three parties. Basically, first party, the partnership firm itself; the second party, the partners themselves; and the third party. The third party are the outside liabilities or the creditors themselves. In all these three parties, the most important party are the partners themselves. The Indian Partnership Act 1932 says that partners act both as agent and as principals. Now, as agent, we mean to say that a partner by his or her act can bind the remaining partner or partners. By his acts, a single partner or more than two partners can bind the remaining partner or partners by his or her acts. This is this is in the context of when partner is treated as an agent. Now, when partner is treated as a principal, then in this case, the partners will be bound, or rather, they will be bound by the act of other partner or other partners. So, this is a very important concept. This is basically a very important concept of partnership under the Indian Partnership Act 1932. Now, to make this session a bit interactive, can anybody let me know that how many, rather, what is the maximum limit of the partners in a partnership firm? Can anybody let me know that what is the maximum number of partners in a partnership firm? Anybody? Archit sir is there, Sumita ma'am is there, Shilpi ma'am is there. Anybody can help me out that what is the maximum limit? What is basically the maximum limit of partners in a partnership firm? I'm waiting for the answers. If anybody can help me out. Anybody? Nobody? Nobody? Okay, let me give you the answer. The maximum limit of the partners in a partnership firm is 100. And this limit is given, or rather this limit is given by the Companies Act. This limit of the number of partners is not given by the Indian Partnership Act 1932. It is given by the Companies Act 2013, and before 2013 we had Companies Act 1956. When we had Companies Act 1956, then the maximum number of partners were 20. When Companies Act 2013 came into force, then this limit was increased to 50 partners. But as we move forward, there was an amendment brought in the Companies Act 2013, and this limit is increased to 100 partners. Now, moving ahead, the first ledger account which we basically learn in partnership form of business is PL appropriation account. Basically, appropriation means distribution. Appropriation stands, or rather the English meaning of appropriation is distribution. Now, before starting the concept of PL appropriation, there are few things which have to be kept in mind. The first rule of PL appropriation is debit all expenses and losses, credit all incomes and gains. And in this session, as I've told you all earlier, that partnership form of business, to understand the concept of partnership, it is very much important. It is very much important to divide partnership into three parties. First party, that is the partnership firm itself. The second party, the partners themselves, and the third party are the outside liabilities or the creditors. Now, as I said, PL appropriation. Now, while making PL appropriation, the first thing which has to be kept in mind is the same rule which applies to trading PL, the same rule applies to PL appropriation too. The rule is debit all expenses and losses and credit all incomes and gains. The second rule, and this rule is of very much importance. It is basically the soul. It is basically the soul of PL appropriation. If you want to understand PL appropriation, if you want to go to the core of this subject, if you want to go to the core of this chapter, partnership, the whole 5 chapters, it is very important. It is very, very important to understand this second point. The second point is whenever you make PL appropriation, you assume yourself as the first party. You assume yourself as the first party. The first party, that is the partnership firm itself. Now, the two rules are clear. The third and the most important rule comes now, that when that when we make PL appropriation, then everything what comes in PL appropriation, it is very much important to know that what basically comes in PL appropriation. When the rules are not different, the rule for trading PL is also debit all expenses and losses. The rule for PL appropriation is also debit all expenses, losses, credit all incomes and gains. Then what is basically the difference between trading PL and PL appropriation? Remember one thing, and remember one thing for sure. In partnership firm also, in partnership form of business also, we make trading PL, but PL appropriation means everything which is of revenue nature. I repeat myself, everything which is of revenue nature and which is connected to the partners. Everything which is of revenue nature and which is connected to the partners. That is everything which is being paid to the partners by the partnership firm, which is being paid to the partners by the partnership firm, and everything which is being charged by the partnership firm from the partners. But it has to be revenue in nature. It has to be revenue in nature. Revenue means recurring in nature. It has to be recurring in nature. Revenue means it has to be recurring nature. Recurring in nature comes in PL appropriation account. Now, let's start up with PL appropriation, that what comes on the debit side, what goes on to the credit side, and etc concepts. Now, the net profit from trading PL is brought down in PL appropriation account on the credit side. On the credit side. Why so? Credit all incomes and gains. So net profit is brought down to the PL appropriation account. Then interest on capital paid to the partners, salary paid to the partners, commission paid to the partners. They go to the debit side. They go to the debit side of PL appropriation account. Why? Because what I said, when you make PL appropriation, you assume yourself to be the partnership firm. When salary, interest on capital, commission is being paid to the partners, it is an expense for the partnership firm. That is why I said, assume yourself as the partnership firm. Assume yourself as the first party when you are making PL appropriation account. Because who is paying to the partners? The partnership firm is paying to the partners. So it is an expense for you. It is an expense for the partnership firm. So interest on capital, salaries to the partners, commission to the partners, they go on to the debit side of PL appropriation account. Now, any drawings which are being done by the partners during a financial year, drawings we mean drawings by drawings we mean to say that money withdrawn by the partners for their personal use. Drawings, the meaning of drawings is that money which has been withdrawn by the partners for their personal use is drawings. So IOD, interest on drawings is being charged, is or rather will be charged by the partnership firm from the partners. So interest on drawing will be treated as an income to the partnership firm, and interest on drawing goes to the credit side, of PL appropriation account. Now, we balance the amounts, we total the credit side, we minus the amount from the debit side, and we get profit. Now the remaining profit is known as the distributable profit. The remaining profit is known as the distributable profit. Net profit, there's a huge difference. Let me make this very clear to all the people who are listening to me and to each and every student of class 12th. There is a huge difference. A difference of a day and a night between net profit and distributable profit. But there's one more thing which comes in PL appropriation. One more thing which comes in PL appropriation and which goes on to the debit side of PL appropriation. Now that thing is general reserve. That thing is general reserve. Now, in the question, let assume, because I don't have a whiteboard, so I'm extremely sorry for that. But still, let it make it very clear. Just to clear the concept, we'll just frame an example, a very small example, a very small question, just to make the concept very clear to you all. Let assume there are two partners A and B. Let assume that there are two partners A and B. The profit sharing ratio between the two partners is 1 is to 1. The profit sharing ratio between the two partners is 1 is to 1. Okay. That means that if a firm earns 1 rupee, then 50 paisa will go to A and 50 paisa will go to B. Now we are moving forward. In the question, it says that 10% of the net profit, mark my words what I'm trying to say. 10% of the net profit, we will make a general reserve of 10% of the net profit. Okay. Let let us assume that after adjusting everything in PL appropriation, the distributable profit left is 50,000. The distributable profit left is 50,000. And the net profit which has been brought down from trading PL to PL appropriation account, from trading PL to PL appropriation account is 2 lakh rupees. Sorry. The question says that we have to maintain a GR or a general reserve 10% of the net profit. Then what we have to do? We will make a general reserve of 10% of 2 lakh rupees. Why so? Because the net profit brought down is 2 lakh. 2 lakh, 10% of 2 lakh is 20%. General reserve will go to the debit side of PL appropriation by 20,000, and then the remaining profit will be 30,000, and this 30,000 will be distributed among A and B in the profit sharing ratio, that is 1 is to 1. 15,000 will go to A and 15,000 will go to B. The PL appropriation ends here. But if the question says that you have to maintain a general reserve of 10%, of the distributable profits, then what we will do? Now then we will adjust all the figures in PL appropriation, and the distributable profit is 50,000. We will make a general reserve of 10% of 50,000, that is only 5,000 rupees. The remaining profit is 45,000, that is 50,000 minus 45,000, and then 45,000 rupees will be divided among A and B into the ratio 1 is to 1. That turns out to be 22,500 and 22,500. Explaining things, seeing to things like this, it seems a bit easy, but when you go for your board examinations, there's a different aura. There's a different aura of pressure on you, and this is the only thing which you all miss. The small things which you all miss. That we have to maintain a general reserve. When teachers go and they check the copies, they know the students know it. But what you all miss? General reserve has to be created 10% of net profit, 10% of distributable profit. These are the things which you all have to pay attention to, because a practical paper, no doubt, is a technical one. No doubt. And partnership is not difficult. Mind my words. Partnership is not difficult. The whole 5 chapters of partnership, they are not difficult. But yes, they are very much technical. Very much technical. A small mistake and your answer from 15,000 per partner will increase to 22,500 per partner. And a small mistake will decrease your answer from 22,500 per partner to 15,000 per partner. A small suggestion to every student who is listening to me: please read the questions very carefully, very carefully. Read the questions twice before you do your work, before you start your work. And To be very truthful, this goes for partnership. This goes for partnership. Now, after explaining PL appropriation, let us move ahead. There are two words in accountancy as charge and as appropriation. As charge and as appropriation. What is the meaning? These are the two terms which are of very much importance in basically in partnership. They are of very much importance as charge and as appropriation. What do we mean as charge? As charge means that we have to pay. A partnership firm has to pay whether the firm is incurring profit or losses in a particular financial year or in a particular calendar year or any 12 months. In any 12 months, a partnership firm has to pay either their profits or their losses. A partnership firm has to pay it pay anything which has been given as a charge. Charge means anything which you have to pay, doesn't matter the partnership firm is incurring profits or the partnership firm is incurring losses. For example, interest on loan, rent, etc, etc, etc. And there are many things which have been given in the question. If they are treated as a charge, if the question specifies that interest on capital will be treated as a charge, then you have to pay IOC. Then interest on capital will be paid. Doesn't matter the partnership firm is incurring profits or the partnership firm is incurring losses. Now, on the other side, what do we mean by appropriation? Appropriation means that it will only be paid, the amount will only be paid if the firm incurs profits in a financial year. If the firm is incurring profit in a particular financial year, then only and only the amounts will be paid. For example, interest on capital, commission paid to partners, salary paid to partners. These are the examples of IOC interest. These are the examples of as appropriation. That if the firm is incurring profit in a particular financial year, then only interest on capital, salary to a partner, or commission to a partner will be paid, or they will not be paid in a particular financial year if the firm is incurring a loss. But remember one thing, if in the question it is given that it is treated as a charge, anything, salary, commission, IOC, anything, if it is treated as a charge, then it has to be paid. And it will be paid. Doesn't matter. It does not matters the firm is incurring profits or losses. And one more thing which is of utmost importance, if anything is treated as a charge, then it always goes onto the debit side of PL account, on the debit side of PL account. Remember this. Anything which is as appropriation and is paid to the partners and is of revenue nature, anything which is treated as appropriation is paid to the partners and is of revenue nature, that is, it is of recurring nature, then only and only it goes in PL appropriation account. Doesn't matter interest on capital goes in PL appropriation account onto the debit side of PL appropriation account, as it is an expense for the partnership firm, it goes to the debit side of PL appropriation account. But if the question says that interest on capital will be treated as a charge, then interest on capital will no longer be a part of PL appropriation. It will go to the debit side of PL account. Remember this. It doesn't matter the firm is incurring profits or losses. If the question says in the board, it comes and the question says that it is treated as a charge, forget everything. Doesn't matter PL appropriation is getting net profit or PL appropriation is getting net profit brought down. Forget everything. Interest on capital treated as a charge will go to the debit side of PL account. And it follows. follows for the same concept. Same concept applies on salary to partners, commission to partners, etc., etc., etc. Now we move forward. There are two terms. There are two more terms: drawings on profits and drawings on capital. Drawings on profit and drawings on capital. Now, one thing, remember the difference is very important, that whenever a partner draws out of profit, when you draw out of profit and when you draw out of capital, when a partner is drawing out of profit, then remember there will be no change in the capital. There will be no change in the capital. The capital will remain intact. The capital will remain the same as it was in the beginning of the year. As it was in the beginning of the year, the capital will remain intact. Why so? Because the partners have withdrawn money for their personal use out of the profits of the firm, out of the profits of the firm. So the capital will not change. In this case, the capital will not change. Why so? Because it is drawings on, yeah, rather drawings out of profits. On the other hand, there is one more term, drawings out of capital. When a partner draws money from the partnership firm for his personal use up and above the profits, that is, he draws out of profits, and above the profits he also draws money from his capital for his personal use, then the capital will not remain intact, and the amount of capital invested by that particular partner will decrease. And why I'm telling you this? Because in the calculation of interest on capital, the IOC, when we calculate interest on capital, the interest on capital will also change. The interest on capital will also change. Now, one thing which I forgot to tell you all, and which is of very much importance, when we calculate interest on capital, remember this: interest on capital is always calculated on the opening capital. We never calculate interest on capital on the closing capital. We always give interest on capital to the partners on opening capital. Remember this. And if in the question it is given closing capital, then we have to reach to the opening capital, then we will calculate IOC on the opening capital. So what we have cleared till now, PL appropriation is almost clear, I think so. What goes to the debit side, what goes to the credit side, why it goes to the debit side, why it goes to the credit side. Then we have given as a small example on general reserve, that what happens, what is the difference between net profit and distributable profit, then as appropriation and as charge, then drawings out of profits and drawings out of capital. Now let us come to the last topic for this session, interest on capital. Very important, it is very important, and please pay, everybody who is listening, pay your attention and try to understand what basically interest on capital is all about. It is of very importance. Now, as I said that interest on capital is always calculated on opening capital. IOC will always be calculated on opening capital. Mark this somewhere, that IOC, whenever we have to calculate IOC will be calculated on opening capital. Now let us start with IOC. Now, if in the question the rate of interest on capital is given, then we provide interest on capital. Let's say there are two partners. Let's say there are two partners. A has invested 5 lakh rupees, B has invested 3 lakh rupees, and the IOC rate is 10%. Then interest on capital to A will be paid 50,000 and to B will be paid 30,000. But the question is silent about anything else. It has just said pay interest on capital 10% to A, 10% to B on their capitals. That's it. But if there are sufficient profits, in this case, if there are sufficient profits, then and then only you will pay IOC. if there are no sufficient profits, that is if the firm has incurred loss, if the firm has incurred loss in that particular financial year, if the firm has incurred loss in that particular financial year, then interest on capital will not be paid. Then interest on capital will not be paid for that particular financial year. Why so? Because the question is not said that interest on capital is treated as charge. Interest on capital is not treated. If the question is not told you, then interest on capital will always be treated as appropriation and the firm has incurred loss, so IOC will not be paid to the partners. Okay, let us move forward. The second case. The second case is quite important. The same example, A has invested a capital of 5 lakh, B has invested a capital of 3 lakh. The rate of interest on capital is 10%. Now, 10% of 5 lakh is 50,000, 10% of 3 lakh is 30,000, and the profit sharing ratio between the partners is 1 is to 1, is 1 is to 1. But in that particular financial year, the firm earns a profit of 40,000 only. Now what to do? Now, here comes a problem. That then what to do? That the firm has incurred a profit of 40,000. The profit is 40,000, and we have to pay IOC. And the total IOC which we have to pay is 50,000 plus 30,000. That is 80,000. Now, the question arises in a student's mind that what to do? What to do? We distribute this 40,000 among the partners in the profit sharing ratio 1 is to 1, 20,000, 20,000 each to A and B, or we give this 50,000 to the partners as interest on capital. But the ratio of interest on capital is not given to us. The ratio of interest on capital is not given to us. Again comes the technicality. It is given. If you can see, it is given. PL appropriation. PL appropriation says that net profit will only be distributed. After giving everything which has been mentioned in the question. Now, what we do of that 40,000 rupees? The interest on capital paid to A was coming 50,000, and which was to the interest on capital which we will have to pay to B was coming 30,000. Now 50,000 is to 30,000. The ratio comes out to be 5 is to 3. 5 is to 3. This is the ratio. 40,000 profit. The firm do not have sufficient profits. Then what to do? We will distribute that 40,000 rupees in the ratio of interest on capital. Ratio, that is 5 is to 3. We will divide 40,000 by 8. 5 plus 3 turns out to be 5,000. A will be paid interest on capital 5 5s are 25, that is 25,000, and B will be paid interest on capital 5 3s are 15,000. A will receive interest on capital as 25,000 and B will receive interest on capital as 15,000. This is what we will do of the profits. This is what we will do when the profit is less, when the profits are less and the amount of interest on capital is more. Now, the third case. This is a bit technical. I said partnership is technical. You must read the question very carefully. Very carefully. The whole question will be given to you. The capitals will be given to you. All the adjustments will be given to you. Profit sharing ratio will be given to you. The rate, interest on capital's rate, the interest on capital rate will be given to you. But in a small line in the end, a very small line in the end, will say the partnership deed is silent. The partnership deed is silent. Now, remember one thing. When the partnership deed is silent, no interest on capital will be paid to any of the partners. I will come down to partnership deed. I will explain what partnership deed is all about. But remember one thing. If partnership deed is silent, then interest on capital will not be paid to the partners. Then interest on capital will not be paid to the partners. Remember this. Same applies with interest on drawings. If the partnership deed is silent, no interest on drawings, no salary, no commission, no interest on capital, no salary, no commission, no interest on drawings will be paid to the partners. Only and only the profit and the losses. Only and only the profit and the losses will be distributed among the partners, and that too equally. And that too equally. That is 1:1. That is in the ratio of 1:1. Say there are two partners, 1:1. Say there are three partners, 1:1:1. Say there are four partners, 1:1:1:1. So it is very important, if the partners have not mentioned anything in the partnership deed. What partnership deed is all about? Basically, it is a written agreement. What is a partnership deed? A partnership deed is a written agreement. Nothing more than that. Nothing more than that. And a partnership deed, a written agreement. So by the mutual consent of all the partners. There has to be a mutual consent. There has to be a mutual consent of all the partners. That's it. A partnership deed is a written agreement. But if there is no partnership deed, but if there is no partnership deed, then no interest on capital will be paid, no salaries will be paid, no commission will be paid, no interest on drawings will be charged, and doesn't matter whatever the profit sharing ratio is given in the question, but if the partnership deed is silent, then the profit sharing ratio between the partners will be 1:1:1:1:1:1. How many partners are there? Till the extent of 100 partners. Clear? This is all partnership deed is all about. Now, as I've told you all, that always calculate interest on capital on the opening capital, never on the closing capital. We never calculate IOC on closing capital, always on the opening capital. So these are few basics, or rather these are few concepts of the chapter partnership fundamentals, and I think so I've covered few important topics which will help you out in solving your questions of partnership fundamentals. uh, we have discussed partnership deed 2, interest on capital. We have discussed almost, we have covered few topics. So I would like to end my session now, and in the end, I just want to say to you all a very small message, a very, very, very small message to you all, to everyone out there. You know, our country is going through very hard times. We are facing very hard times. Please stay at home, stay safe, and please, please do as the government is asking you to do in whatever state of the country you are sitting. Do as the government of the state, or rather the central government, is asking you to do, because this is the only way out of COVID-19. This is the only way out. This is the only way out. By staying away from each other for a certain time, we can maintain a bond with each other, because the numbers are increasing day by day, as you all can see, as we all can see. And please stay at home. Whatever you want to do it at home. Stay safe, stay healthy. Hope we will meet in the next session, in our next session. uh, till then, goodbye, take care, and stay healthy, stay at home. Thank you. Thanks a lot. Thank you everyone for attending the meeting, for attending the session. Thank you. How to say, if you end the session live, then now you'll be able to choose.